One misunderstood term can derail your entire investment strategy. Don't let language barriers cost you million-dollar opportunities. Let's start our lesson.
All right, so we're back for another deep dive, and today we're going to be tackling the investment landscape in 2025. We've got a ton of expert reports to dig through. Fidelity, JP Morgan, Deloitte, Vanguard, McKinsey, even Forbes and Investment Monitor chimed in. So our mission today is to pull out the most important bits of all of that and give you a Q view of what to watch for this year.
Yeah, definitely a lot to unpack. So we're going to break it down into three key areas that really stood out in these reports. First, we'll look at specific investment strategies that are being recommended for 2025, where the smart money's going. Then we'll shift gears to the economic side of things, particularly the impact of policies, mainly in the U.S., because that's going to have ripple effects everywhere. And of course, no deep dive into investing would be complete without talking about the huge role of technology. It's changing everything, right?
Absolutely. Okay, so let's jump right in with those investment strategies. One that popped up in a few of these reports was small and mid-cap stocks. Fidelity, for example, pointed out that they actually outperformed the S&P 500 in the last few months of last year, plus they saw a nice 2.7% bump in January. So what's the thinking behind that? Why are these smaller companies looking so good right now?
Well, it's not just that they're statistically cheap right now, based on their price to earnings ratios and stuff like that. Fidelity actually highlights that these companies are seeing accelerating profit growth as well. So you've got this combo of undervaluation and increasing profitability, which is like a growth investor's dream, right?
Right, so it's not just about getting a bargain, it's about finding companies that are actually on the move.
Exactly. And McKinsey had an interesting point in their report, too. They suggested that these smaller, more domestic-focused companies might actually be a bit more shielded from some of the global economic headwinds that we've got going on, compared to those huge multinational corporations that are exposed to everything.
Yeah, that makes sense. But I guess the flip side is that they could be more vulnerable to problems in their specific regions.
Yeah, that's the trade-off for sure. Less global exposure means less global risk, but it also means less diversification, less of a safety net.
Okay, so another area that's getting a lot of attention, and this was in Fidelity's report as well, is financial stocks. They had a pretty good run towards the end of last year, but Fidelity pointed out that even with those gains, they're still trading at historically low valuations, like really low. So why are people still so optimistic about financials?
Well, Fidelity pulled out this really interesting historical data point. They looked back at the last 60 years and found that when financial stocks have been this cheap, and I mean in the bottom 25% of their historical valuations, they've pretty consistently outperformed the market over the next 12 months.
So it's like a reliable pattern. Buy low, wait a year, sell high.
Well, I wouldn't call it foolproof, but it is a pretty compelling historical trend. And, I mean, it makes sense when things are that undervalued. There's a lot of room for them to catch back up.
All right, so now for something a bit more complex, convertible bonds. For the folks listening who might not be bond experts, could you just give us a quick rundown of what those are and why they're getting a shout-out for 2025?
Sure, yeah. So convertible bonds, they're kind of like a hybrid. They pay you interest like a regular bond, so you've got that steady income coming in. But they also give you the option to convert them into shares of the company's stock down the line. And Fidelity's been seeing an uptick in these being issued since 2022.
So it's kind of like having your cake and eating it too. You get the stability of a bond, but also the potential upside of a stock.
Exactly. And Fidelity specifically mentions that with expectations of possible deregulation and tax cuts coming up, that could really boost stock prices, which would make that conversion option even more valuable.
Interesting. All right, so moving beyond individual stock types, the reports also talked a bit about alternative investments, things like real estate, private equity, infrastructure. JP Morgan's report went into that in a bit more detail. So why the focus on alternatives in 2025?
Well, they break it down into a few different factors. With real estate, it's the ongoing housing shortage, especially here in the U.S. That's created a lot of demand, which obviously drives prices up. Then for infrastructure, the big driver is technology, actually. All these advancements in AI and stuff, they need a lot of power, a lot of computing power, which translates to a need for more energy infrastructure.
So that's kind of a hidden tech play in a way, like investing in the backbone that makes all the cool tech stuff possible.
Right, exactly. And then for private equity, the thinking is that lower interest rates, which we'll get into more later, are likely to lead to more mergers and acquisitions, which is where private equity firms tend to thrive.
Got it. So those are some pretty solid reasons to at least consider dipping your toes into the alternative space. Now let's talk about consumer discretionary stocks, companies that sell things we want, not necessarily things we need. Fidelity seems to think those are looking pretty good for 2025. They specifically mentioned companies related to new cars and online shopping. What's the rationale there?
Well, their analysis shows that these companies are currently pretty cheap relative to the amount of free cash flow they're generating. And for listeners who might not be super familiar with that term, free cash flow is essentially how much cash a company has left over after paying for its operating expenses and capital expenditures. So a high free cash flow yield can be a sign that a stock is undervalued.
So it's not just about how much profit they're making, it's about how much actual cash they have on hand.
Exactly. And Fidelity's historical data going all the way back to 1980 shows that when consumer discretionary stocks are cheap based on this metric, they tend to perform pretty well in the following year.
All right, last but not least on the investment strategy front, Fidelity highlighted bank bonds as an interesting play, specifically investment-grade bonds from big, well-capitalized banks. Why the focus on those?
Well, it seems like Fidelity's playing it a bit safe here, focusing on bonds from institutions that are considered very unlikely to default. Big names with strong balance sheets. They looked at these bonds as of late October last year and saw them as being pretty attractively valued.
So it's kind of a stable income play in a potentially volatile market.
Yeah, that seems to be the thinking. All right, so we've covered a pretty wide range of investment strategies there, but of course, all this is happening within a larger economic context, right? So let's shift gears and talk about the impact of economic policies in 2025, especially here in the U.S. That's where Deloitte and a few other reports really dove in.
Right. I know monetary policy was a big focus. I mean, we saw the Fed cutting interest rates quite a bit towards the end of last year, a total of 100 basis points, which is basically a full percentage point. Plus, we finally saw inflation start to cool down a bit. That PCE price index came down to 2.3% in October. So what's the outlook for interest rates and what kind of impact is that expected to have?
Well, Deloitte seems to think that we'll probably see more modest cuts from here on out. They're attributing that to the fact that we've still got some persistent inflation in the services sector. But even with that, the cumulative effect of the cuts we've already seen, plus any additional easing, should help to bring borrowing costs down for both businesses and consumers.
Which hopefully should translate to more investment and economic activity.
Exactly. Now, on the fiscal policy side, things get a bit more uncertain. There's a lot of potential for change depending on, what happens politically. Deloitte actually outlined a few different scenarios in their report.
Right, and they have that baseline scenario where they're assuming that a lot of the more radical policy proposals that got thrown around during the election campaigns aren't actually going to get implemented.
Yeah, and under that scenario, they're projecting a pretty moderate real GDP growth of about 2.4% for 2025. But they also have those more optimistic and pessimistic scenarios, depending on what happens with things like tax cuts, tariffs, and government spending.
Right. So in that more positive scenario, Deloitte sees the potential for GDP growth to hit 2.7%. But on the flip side, if things go the other way, we could see growth slow down to just 1.6% and even potentially dip further in 2026.
Exactly. So there's a pretty wide range of possibilities there, which definitely makes things a bit more challenging for investors.
Absolutely. Now, what about trade policy? I know that was something that Russell Investments brought up. How could changes in trade policy impact things?
So Russell Investments pointed out that if we see gradual increases in tariffs, that could actually give a little boost to consumer spending here in the U.S., at least in the short term. Because imports become more expensive, people might buy more domestic goods. But overall, their analysis suggests that the impact on GDP is likely to be negative.
So it's kind of a short-term gain, long-term pain situation.
Yeah, that's a good way to put it. And the bigger issue they highlight is the uncertainty surrounding trade policy. When businesses don't know what's coming down the line, they tend to hold back on investments and expansion.
Which obviously has a ripple effect throughout the economy.
Right, and their analysis suggests that this uncertainty could actually shave off a good chunk of GDP growth, like half a percentage point in both 2025 and 2026.
Wow, the trade policy definitely has the potential to make a big impact. Now, one last thing on the economic front. Vanguard's report touched on inflation and some other global factors that investors need to keep an eye on. What were their key takeaways?
Well, Vanguard basically echoed what Deloitte said about inflation. It's cooling down, but that service sector inflation is still a bit sticky. They're projecting pretty average GDP growth, around 2.1% for 2025. But what they really emphasize is that all those geopolitical tension, like the war in Ukraine and the instability in the Middle East, those could throw a real wrench in the works.
Yeah, those are definitely wild cards that could create a lot of volatility in the markets. Okay, so we've covered investment strategies and the economic outlook. Now let's get to the really exciting stuff. The role of technology in 2025. McKinsey and Forbes had some really interesting insights here.
Definitely. And you can't talk about tech without talking about AI and machine learning. They're everywhere. McKinsey's research highlights how these technologies are being used to analyze data, find patterns, and even create entirely new revenue streams. This isn't just sci-fi anymore. It's happening right now across tons of industries.
Yeah, Forbes even highlighted the increasing importance of scalable platform technologies, like those that can be applied to many different industries and grow rapidly. I guess that makes sense for investors, right? You want to bet on something that has broad applicability.
Exactly. It's not just about niche solutions anymore. It's about finding those foundational technologies that can fundamentally change the way businesses operate.
And of course, with all this tech comes the need for security, right? Investment Monitor had some pretty eye-popping projections for the growth of the cybersecurity market.
Yeah, they're expecting it to explode. They're projecting global market to hit $344 billion in revenue by 2030. That's huge. And it just goes to show how critical it is to protect all this digital stuff from increasingly sophisticated threats.
Yeah, it's like the cost of doing business in the digital age.
Right. And speaking of the digital age, we can't forget about cloud computing. McKinsey pointed out that a huge majority of leading companies have already gone all in on the cloud. So what does that mean for the rest of us? Well, McKinsey's data shows that this mass adoption of cloud is leading to major gains in speed and scalability for businesses. But they also point out an interesting challenge: managing the financial side of cloud usage, which is often called FinOps. Apparently, a lot of companies are still struggling with that, which could be a big opportunity for companies that can provide solutions in that area.
So it's like the next frontier of cloud computing, figuring out how to make it financially efficient.
Exactly. All right, so beyond those big overarching tech trends, the reports also touched on some other areas that are impacting the investment landscape. We've got data analytics and big data, which are changing the way investors make decisions by giving them access to massive amounts of information that they can analyze quickly.
Yeah, Forbes talked about how that's leading to faster, more informed decisions, which ultimately makes the market more efficient. And then there's the whole world of automation and robotics, which is just accelerating like crazy. Investment Monitor had some pretty impressive growth projections for that sector.
Yeah, they're predicting the global robotics market to reach $218 billion by 2030, and that growth is especially strong in service robotics, which is pretty interesting. All this automation is leading to process optimization, cost reduction, and productivity gains across all sorts of industries.
It's like the future's happening right now, and investors are trying to figure out how to capitalize on it.
Exactly. And speaking of the future, we're seeing a huge surge in interest in sustainable technology, which is also influencing investment strategies. Companies are increasingly committing to carbon neutrality and ESG goals, which is creating demand for all sorts of environmentally friendly technologies.
Yeah, Daffodils had a report on that, and they basically said that investors are becoming more and more interested in companies that are aligning their operations with these sustainability goals.
Makes sense, right? It's not just about products anymore. It's about doing good for the planet as well. And of course, with all these technological advancements comes the need for regulation. Deloitte pointed out that regulatory compliance technology is becoming increasingly crucial, especially with all the new data privacy laws and AI regulations that are coming into effect.
Right. They highlighted the need for investments in things like ERP systems, cybersecurity measures, and robust data governance frameworks to make sure companies are in compliance with all these new rules.
Yeah, it's another one of those costs of doing business in the digital age, but it's essential for avoiding penalties and maintaining a good reputation.
All right, so we've covered a lot of ground here. As we wrap up this deep dive, what are the key takeaways for investors heading into 2025?
Well, it's a pretty complex picture, but I think the main thing is that there are a lot of moving parts. On the one hand, we've got some promising investment strategies, like those small and mid-cap stocks, financials, and convertible bonds. But on the other hand, the actual performance of those investments is going to be heavily influenced by economic policies, both here in the U.S. and globally, and those policies are still pretty uncertain.
Yeah, there's a lot that could change between now and the end of the year, both on the economic and political fronts.
Exactly. And then underpinning all of this is the relentless march of technology. AI, cloud computing, cybersecurity, these are all major forces that are reshaping the investment landscape.
So it sounds like investors need to be really adaptable and stay informed about all these different trends.
Absolutely. The insights from these reports really underscore the importance of understanding how economic policies and technological advancements are intertwining and influencing the investment environment.
So for our listeners out there, here's something to think about as you digest all this information. How might those specific technological trends that we discussed create new winners and losers within those investment strategies we explored earlier? Like, how might the rise of AI impact the profitability of those small-cap companies versus the larger, more established players? That intersection of ideas could reveal some really interesting opportunities or potential risks in the year ahead. So definitely worth pondering as you do your own research and planning. Thanks for joining us for this deep dive.
Thanks, everyone.